Guys, today we'll be going over a very simple liquidity sweep strategy. I have just put some writing on the chart just for some key bullet points to remember for this strategy. So number one is we're going to want to identify our higher time frame draw on liquidity. We're going to want to wait for a run on liquidity in opposing direction. Take any fair value gap on the 5M or 15M, and we're going to target higher time frame direction. So if here, what we have on the daily time frame, this is the New Zealand dollar and US dollar. We can see on the daily time frame that we have here a run on liquidity. We have buy side liquidity taken here, followed by a sharp displacement to the downside, hunting sell side liquidity, and obviously breaking structure to the downside. We then give a corrective pull back, as you can see here, dropping very, very clean lows for a low resistance liquidity run. This would be our higher time frame draw on liquidity, HTF DOL. Okay, why is it our higher time frame draw on liquidity? Because you see here, we run buy side liquidity and displace. So this in itself is a run on liquidity, which makes this high resistance. So this is going to be our high resistance liquidity run, and nothing down here runs liquidity. So this is going to be low resistance, right? There's almost no displacement. There's no grabbing of orders to the downside before displacing to the upside on this sell side here. However, on the buy side up in this area, we have an aggressive hunting of orders and then a displacement to the downside. So we also denote our range, and we can see that we are trading in a premium market, specifically the top 30% of the range. So now let's drop down to a 1 hour time frame and see what we have going on here. So we want to be finding our point of interest first that we want to be taking entries off. You don't want to just be trading any random highs and lows. You want to make sure that it's also coming from a valid area. So if you notice here, we have this H1 order block, and if we just denote the body here, we can denote our equilibrium point, which would be, can't see my, oh, there we go. We can denote our equilibrium point, which would be this range here. So now I can remove this because this is our H1 equilibrium of our H1 order block. So we want to identify our higher time frame drawn liquidity. Now, as a sort of midterm drawn liquidity, we have this set of clean equal lows. So this could be a good first target to aim for. And obviously we have another set of equal lows here, which is our higher time frame, drawn liquidity here. Notice low resistance liquidity run, high resistance liquidity run up here. So now we want to wait for a run on liquidity in opposing direction. So here we have buy side liquidity taken into our mid time frame point of interest, which is this H1 order block equilibrium point. Now take any fair value gap on the 5M or 15M time frame. So we'll do the 15-minute time frame first. We drop down to the 15-minute time frame here. Also notice that this on the H1 time frame, we close back inside the range. So we expand out of the range, we sweep out of the range by around about 4 pips, but the candle bodies, they close back inside the range. And this also is the same on the 15-minute time frame. You can see we do not have a close outside of the range. So take any fair value gap on the 15-minute time frame. Where's our words? Our words are here. Let's bring them back. The reason why we want to look for fair value gaps is because it shows displacement. If there's no fair value gaps, it ultimately shows there's a lack of displacement. I personally prefer trading from order blocks, but the fair value gap paired with an order block shows that there is displacement in the market and an imbalance in orders, let's say. So we have a 15-minute fair value gap here, and we also have our 15M order block here. Why am I selecting this level? Because we have 4 consecutive bullish candles with no change in the state of delivery. You see, we have bullish, 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 bullish. So these 4 candles would be my order block. And we can take our entry here, either covering this rejection block up here. You can either cover this wick, or if you're wanting, you feel confident, you can cover the candle that created this fair value gap or this breaker block. It's totally up to you how you want to, obviously, stop placement. Just make sure it's in a relatively safe place. Don't do anything stupid like this. Give it a nice bit of breathing room. So for the sake of this video, we will use this 15-minute breaker block. See, we have low, high, lower, low. So this is also, see, we have a breaker block here on the 15-minute time frame. So as you can see, we're building confluences, right? It's not just we're taking a fair value gap, we're taking an order block. You see, we have confluences of 3 or 4 different things. We've got a run on liquidity into our higher time frame level. We have candles that are respecting the previous range that we've swept. We have a 5M breaker block. We have a 15-minute breaker block. We have a 15-minute fair value gap, and also a 15-minute order block range. And we can then be targeting our target 1, which would be these set of relative equal lows down here, like so. And this trade is still planning out. So next week, I'm expecting a continued move to the sell side, hunting obviously those equal lows. And if you notice as well, on the daily time frame, we have this daily bullish order block that price could potentially seek, which is about 140 pips below current price. Now I will show you guys the 5-minute entry, which you will usually get in the 5-minute entry before the 15-minute entry, just because it is a slightly shorter time frame, but both are okay. Neither one's better than the other. Personal preference. So here we have our sweep on liquidity, which is this area here. Obviously the 5M does close out, but it is, like I said, a very shorter time frame, so don't worry about that too much. And we have as well our shift in market structure on the 5-minute time frame here. We've also got a 5-minute breaker block here, paired with a 5-minute fair value gap. Our 5-minute fair value gap here. And I would denote this as the order block. Why would I denote this as the order block? Because as you see, we do have a down candle here. But if you look, this is the most volumetric bullish candle, followed by 2 considerably smaller candles. So I would still, in this instance, prefer to use this whole range as the order block, just due to how volumetric this bullish candle is here. It's a strong body, small wicks. And if you were to just use this level, you may end up not getting tagged in. As you can see here, we just wick up into this fair value gap and you would miss the entry. So we can take our entry at the fair value gap. We can either cover this rejection block here, or we can cover the swing high. Both gives you nice risk to reward. And we'll be obviously targeting our drawn liquidity to the downside. So that's basically it. That's how simple it is. You're just waiting for that Judas swing, which should give you a run on liquidity in the opposing direction. Then you're waiting for displacement in the desired direction, and you want to take any 5M or 15-minute fair value gap and target the higher time frame draw on liquidity. And like I said, like I explained in this video, it is good to stack your confluences. So, we've had a breaker block, we had an order block, we had a fair value gap, all within the same area. So, which basically means that that area is going to be very, very high resistance to break through. And then you obviously want your stops in a reasonable place, which still allows you for a decent risk to reward ratio, but without being, too stupid. Something like this, is just completely unnecessary. Yeah, that's basically it. And make sure you join my free Discord. The link's in the description. So yeah, I hope to see you in there.